I started just a couple months before Matt Cain, our CEO, started, and he brought the framework, but I'm a believer in it, which is sustained differentiation, profitable growth, and world-class teams. And those are our three pillars. And Matt brought those in day one, and still today, almost every all hands we have, like that goes up, right? That's the framework.
Is this thing on?
Yesterday's price is not today's price.
Hey, what's going on, everybody? This is CJ Gustafson, the host of the Run the Numbers podcast. And you may notice that lately I have not been reading my notes. That's correct. I got some unsolicited advice from someone who's a friend, but also doesn't have a podcast. Just kidding. I love you, Nicholas. He said, I like you better when you don't read the notes. I think you know it all. Just go straight off the dome. Your choice, man. Dealer's choice. I could say anything. I could say anything at all. But this podcast you're about to hear is with none other than Greg Henry, the CFO of Couchbase. It's always a pleasure to talk to someone with so much experience as Greg. He's a really generous guy with his time. He was explaining that he likes to give back at this point to younger CFOs. So it was cool for him to jam out with me for about an hour. Our friends over at Founders Circle had linked us up. And right off the bat, I asked him, hey man, I was listening to one of your recent earnings calls. You have non-standard fiscal years. Can you explain to me why people do that? What are the benefits of doing so? Because it is kind of confusing, especially when you're budgeting. But like, what's the benefit? There must be something behind it. We talk about his experience transitioning from a historically enterprise subscription business to a managed service consumption business, which is a hot topic in the markets today. A lot of companies are doing that. We talk about the journey and how it was much bigger than just a pricing and packaging change. We also talk about why Greg and Couchbase guide to ARR, why that's a North Star metric for them. We think through renewals, big deal risk, and RPO. Yeah, baby, a remaining performance obligation. We spent a ton of time in this podcast talking through how you work with sell-side analysts, the relationships there, the questions they ask you, how callbacks work tactically. So afterwards, he'll go into a room with the CEO and they'll call analysts back to go even deeper on their questions about their business model and the results. And then we go through the buy side, how he manages his time. He could, technically spend all his time every week just talking to investors who want to get in on the stock. But how do you balance that with running the company? And finally, we talk about working at GE during the heyday, the culture, what it was like then. What were the vibes at GE? This was right after Jack Welch left, and some of the concepts and frameworks that he brings to Couchbase today. Hey, do you love this show? Do you like Yeti mugs? A couple of our favorite listeners right now are sipping something tasty. Maybe it's a margarita and it's happy hour. Maybe it's an ice cold coffee. They're getting caffeinated, jacked up for the day out of a Run the Numbers Yeti mug, because they sent me an email at cj@mostlymetrics.com. And they said, hey, look, I shared this in my Slack and Microsoft Teams channel. I sent a link to all my peers and said, this is the best podcast ever. Check it out. You should do the same. I'll hook you up with a Yeti mug. I promise. All this and much, much more after a short word from our sponsors. Mercury knows your financial operations are complex. Founders and finance teams have to pull together different tools, reconcile transactions from different sources, and struggle to get accurate answers. With Mercury, you can simplify your operations with banking and software that power your critical financial workflows, all within the one thing every business needs, a bank account. And with new bill pay and accounting capabilities, you can pay bills faster, stay in control of company spend, and speed up reconciliation. Apply in minutes at Mercury.com and join over 200,000, ambitious startups that trust Mercury to provide the precision, control, and focus they need to transform their financial workflows so they can perform at their best. Mercury, the art of simplified finances. Mercury is a financial technology company, not a bank. Banking services provided by Choice Financial Group and Evolve Bank and Trust. Members FDIC. I'm getting good at that voice. Quick math. The less your business spends on operations, on multiple systems, on delivering your product or service, the more margin you have and the more money you keep. That's the goal, isn't it? But with higher expenses on materials, employees, distribution, and borrowing, everything costs more. Yesterday's price is not today's price. So to reduce costs and headaches, smart businesses are graduating to NetSuite by Oracle. NetSuite is the #1 cloud financial system, bringing accounting, financial management, inventory, HR into one platform and one source of truth. With NetSuite, you reduce IT costs because NetSuite lives in the cloud with no hardware required. Access from anywhere. You cut the cost of maintaining multiple systems because you've got one unified business management suite. You improve efficiency by bringing all your major business processes into one platform, slashing manual tasks and errors. Over 37,000 companies, wow, that's a lot of customers, have already made the move. So do the math. See how you'll profit with NetSuite. And back by popular demand, NetSuite has extended its one-of-a-kind flexible financing program for a few more weeks. Head to netsuite.com/metrics. That is netsuite.com/metrics. Ooh, yeah, you know your boy loves some metrics. That's netsuite.com/metrics. Please do it, guys. I really need this. Greg, welcome to the Run the Numbers podcast.
CJ, thanks for having me. Looking forward to this.
I'm pumped for a great conversation. I kind of feel like I sort of know you because I've been reading through all your earnings transcripts. I don't know if that's creepy or not. But I noticed in the last call that you have non-standard fiscal years. A lot of companies have non-standard fiscal years, but I've never been able to really nail down why that is. Can you speak to the rationale or the benefits that you see in creating that offset?
Yeah, interesting question. So I joined Couchbase in late 2016, and one of my first things was to move us from a calendar 12/31 to a 1/31 fiscal year. The benefits I saw back then, and I still see them today in particular, is it's really difficult for the sales org to close deals between, the US Thanksgiving and then the New Year timeframe with many people on holiday and taking time off. So that's always a challenging time. So we just want to take that out of that. The majority of companies at that time were on 12/31, so we wanted to have that sort of offset to that. If the day we went public, we'd have the opportunity to sort of have a little bit more clear airspace from an earnings perspective. And then, I'd be lying if I didn't say this selfishly. We don't have to do the big year-end close July 4th. So it offers the finance community a little bit of a break around some of the holidays versus my historic career being a 12/31, working through, Christmas to New Year's, July 4th. So there was a little bit of that, but mostly for the sales team.
Maybe an odd question, but as a CFO, does it also help you as a buyer? Because there is kind of a compelling opportunity or like an event that's created around getting deals done on time.
Absolutely, because the opportunity is a lot of the companies that are our customers have 12/31 year ends, and they're going through either the budget exercise of, budgets are changing over from year to year. So there is this sort of budget flush concept at 12/31 you can take advantage of, or new budgets open in January for their new fiscal years. And so you could actually get deals done in January, which then for us is in our fiscal year. So yes, there's absolute benefits to that.
If you were coaching a young CFO who had, their druthers to pick whatever the fiscal year is going to be, what's the ideal year that you would pick, start and end?
Well, I've lived in the 1/31 year end now for 6-7 years. I like that. I know some people put theirs out to like July 31st and whatnot, but this one's worked well for us. It's close enough to how most people run on the regular calendar year that you're not completely disjointed, but you still have that slight offset. I mean, it works great for us because we finish in January, we get our sales kickoff in February, we're off and running. It's worked really well for us.
And I like how you said having the sales kickoff in February and being ready to go then, because one of the marks of like a really good annual plan is that you have sales comp plans for the sales team in hand by that sales kickoff. So there's no like, well, how much am I going to get paid on these deals?
Right. And we want to do it like we literally do our sales kickoff the first week or first full week in February. That's very difficult to do in January because you still have people coming back from holidays at various times. And so it's just worked out very well for us. And we get everybody energized, excited about the year, comp plans ready, and the field goes off and starts their year.
Well, calendar year is something that finance people actually get excited talking about. Greg, you have this experience transitioning a historical enterprise subscription company to a managed service consumption business. I want to dive into what that journey was like.
There was a lot of learnings, right? There's not a lot of mature consumption companies, so we were really learning as we go. But it was exciting because we know it's the model that our customers want long term. But yeah, it was challenging to figure out there's different revenue recognition, whether it's subscription or consumption. It's a whole different mindset for the teams that are selling as well as the finance team because these subscriptions are set terms. So you have these discrete renewal periods versus consumption where you sell them, in our case, a bunch of credits and they consume it. It could be in 2 months, it could be in 6 months, it could be in 12 months. You don't know. So there is no such thing as a renewal. They buy and then they come back and rebuy. But the buying activity doesn't immediately dictate ARR revenue, it's consumption. And so you have to get into that consumption mindset very quickly, both from our perspective in finance, understanding how it works is it is different than subscription, but at the same time, making sure you get the field teams to understand how that consumption works, making sure you're incentivizing properly to get them to work on consumption. So it's just a different model. We learned, obviously, there's a number of companies now, Snowflake, Datadog, MongoDB, who are well-scaled consumption companies, and we learned from them, but we're still learning all the time. I remember going back, I had the opportunity to work at ServiceNow for Mike Scarpelli and asking his team about, why do you guys not talk about ARR or anything, right? That to me seems like a really important measure. The reality is if you're truly on full consumption, revenue is ARR and vice versa. So you don't need those two metrics, separately. So it was just, again, it was a lot of learnings. It's very interesting. And look, we disclose our Couchbase Capella now, which is our consumption managed service model, and we're at 11.5% of our ARR is now there. And so we're still going through that transition as we get to have, the predominant part of the business there. But it's been some really, really fun learnings. And look, from the other thing, as I say, at the very beginning, we set out, and Matt, our CEO, said, we have to think about this. We're really running two business models now, and we have to think of them separately and not try to commingle them. And so we really think of those as two separate businesses in terms of how we run it. And that's really helped us as well.
On the Mike Scarpelli point for the Snowflake Investor Day deck, I don't know why I think this is hilarious, but they have this slide that says we are not a SaaS company or we are not a subscription company. Basically, we're usage-based, so don't try to treat it like something it's not.
But it's true, and I understand the point. And if you go back to our Investor Day back in December of 2023, we had to lay out something very similar to help the investors understand how that's different and how the transition is going to be different, right? In terms of the rev rec and the timing and all that other things that go along with being a consumption model. So I very much better understand why that was laid out that way. And as they laid out, and we did too, again, it's not about the buying activity, it's the consumption. That's what the driver is. And if you get customers consuming and they like it, they will buy more. And that's what you want them, the state you want them to be in.
And you kind of hinted at this, but I imagine, Greg, it was a much bigger change than just pricing and packaging, right? It's not just this, we price differently, go buy it. What other changes did you have to make within the org when you made this journey?
Well, like I said, we thought of it right away as being two different business models, right? And that was the sort of the beginning of, we can't look at anything different. So it's how we forecast the business. We had to build operations around a consumption business, right? Tracking consumption, who's over consuming, who's under consuming, why are they doing that? A real operational aspect to it, sales compensation plans, the way we, track from a finance perspective. I mean, everything changed. Again, it's really like running two business models, and you have to treat them extremely differently, because if you try to commingle them, and look, we still have some of that, right? We're still working through some of that where we keep talking about, well, the customer is going to renew. And I have to remind people, they don't renew on a consumption basis. There's little chance they're going to come back exactly 12 months later and buy more. They're probably going to come back actually sooner and buy more because they're consuming. And if you're smart about your consumption, like how when we buy infrastructure from the cloud players, we don't buy at 100% of our forecast. We buy at 60 or 70%, right? Because we don't want to, for any reason, run out and have dead weight. And so we had to get the sales teams thinking you don't have to get the biggest deal in the world. Just get them started. They'll buy more. It's not, you have to wait for a year. So it's just a mind shift. Again, forecasting, operations around it, managing it, different business model.
I love how you say just get them started, because if the product is good, it will take care of itself and it becomes part of your core workflows and just how you do business after a while. It's just the cost of, running a company, and it's less about selling this whale of a deal with all the pressure.
100%. And CJ, that's why one of the things, and I'll give our CRO Hugh Owen credit, he's like, we got to come up with these starter packs. They're very small, $1,000, $5,000, $25,000. discounted credits, bundle services just to get customers going. Because if you get them started and they like it, like you said, if they like the product, they will come buy more. And look, we can all think about that from our consumer experience, right? When we find a product that we like, we tend to keep buying it. In some cases, we buy more. So same concept.
And you touched on it a bit with ARR. You do guide to ARR. I always go back and forth. Like, why do some companies shy away from it and just stick to GAAP revenue? Is there a risk in that? Or what's just kind of your mindset with guiding to ARR?
Well, for us, we're a enterprise infrastructure business, and we sell to large enterprises, and we typically do large deals, and we do multi-year deals a lot of the times, and multi-year deals that grow. And we want to be able to demonstrate what that looks like when the deal is done. So let me give you an example. It's a bit of an extreme one, but just to make the point, if it's January 31st, which is our last day of our year, and I sign $1 million deal with a customer, and it has a start date of February 1st, right? In the traditional, we have a sort of different than a traditional ARR definition. You would show a booking for sure, but most people don't do bookings. You'd have no revenue because it doesn't start till February 1st, and you'd have no ARR under a traditional ARR definition. That to us doesn't represent what's happening in the business. So our ARR definition is we take everything running at the end of the period and we look out 12 months beyond that, because we want to incorporate like, hey, we did this $1 million deal. Yes, it's starting one day later than our fiscal year, but you as the investor or financial analyst, you'd want to know about this. Yes, you can see it in RPO, but you can't really tell exactly. So that's our definition. ARR for us has been our North Star from the beginning. Now, look, over time, as I mentioned earlier, when you get to be predominantly on a consumption model, ARR becomes less meaningful because ARR and revenue sort of equal each other. But for us, ARR has been the North Star because we want to drive growth. We want to drive future growth. We want to have embedded contracts that grow during their period. So that's how we can, best demonstrate it to the street.
That's a great explanation and kind of where your mind is at. Greg, you must love RPO then, just hearing you describe ARR. Do you find a lot of benefits of, I guess, looking at RPO even internally to guide the business, but also communicating it to the street?
Yeah, I mean, we do use it internally. I'd say, again, going back to ARR being our North Star, we look at that, that's how we run the business. That's how we, compensate a lot of the business on ARR. RPO is helpful, especially because, again, we're in this large enterprise infrastructure deals. They're multi-year. They can be very big. So it allows us to demonstrate and show, what's in the backlog effectively. I think, if anything, probably CRPO is more meaningful because unless you have the weighted average billings, right, you don't know if somebody put in a big multi-year deal that's sort of propping it up. So CRPO is helpful. There is a sort of a blessing and a curse, though, because in our business, so like in Q4, and you can see this, obviously it's all disclosed, it's GAAP. You saw a huge pop in RPO because we did two very large deals, multi-year, 8-figure TCV type deals. So the RPO just went up dramatically. And we had to explain to folks that, like, look, this is really good. But now those customers are more or less locked in for the most part over this period. And so the RPO is just going to drain off as it becomes revenue until you get to that next period, which will be close to 3 years from now. And then you'll see another pop. So there is some confusion and questions like, why is RPO dropping? And we have to sort of go through that. So ARR, going back to ARR, cuts through all that. So RPO is nice. ARR is, to us, the most meaningful metric.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Annual planning season is upon us. That's right, my favorite time of year. And it's not just about setting goals for the coming year. It's about ensuring you have the right tools in place to measure and achieve those goals. As a SaaS CFO, I know having access to reliable, real-time metrics is crucial for my annual planning process. That's why I'm so excited to partner with today's sponsor, Maxio. Maxio is a billing and financial operations platform that helps subscription businesses reconcile bookings, billings, GAAP revenue, and SaaS metrics automatically. By the way, guys, bookings, billings, GAAP revenue, not the same thing. Got to get them straight. Because these numbers are the foundation of your financial models, it's important to have quick access and trust that they are correct. Don't let the complexities of SaaS finance and accounting slow you down. If you want to start 2025 with the right tools, check out Maxio by visiting maxio.com/run the numbers. That's maxio.com/run the numbers. Request a demo through our link to support the podcast, ya boy, and receive a 10% discount on your first year with Maxio. That's maxio.com/run the numbers. maxio.com/run the numbers. Please, guys, I really need this. Okay, serious question for all my accounting pros here today. Are you doing what you were hired to do? What I mean is, do you have time to actually be a business partner, or are you buried in tedious manual tasks just to get your journal entries prepared every month? I know how that feels. Leapfin's here to help with that. Leapfin is accounting automation software that automatically prepares and posts reliable journal entries. And that's just the beginning. High-growth businesses like Reddit, Canva, and SeatGeek choose Leapfin to eliminate manual tasks, accelerate month-end close, and enable accounting leaders like you to provide faster insights that will help your company grow. If you're battling messy transaction data from Stripe, Adyen, Shopify, Apple Pay, and other PSPs, and then battling again to get it all into NetSuite, go to leapfin.com to watch their short product intro video. And if you like what you see, request a 15-minute conversation to learn how accounting automation can help you and your team. Check out leapfin.com today. That's leap like jump, fin like shark. I just made that up. I hope they're okay with it. Leapfin.com. Ready to plan confidently, close faster, and report more accurately? Here's what sets Planful apart. Imagine purpose-built applications for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks and with minimal IT involvement, so you can rapidly and seamlessly engage everyone across the business on your key financial progress. Best of all, Planful grows with you. Its unparalleled scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Oh yeah! Go to planful.com/metrics to see how you can reach peak financial performance with Planful. That's planful.com/metrics. It's funny. It's like RPO can almost be a double-edged sword. Like, I got this massive deal. That's awesome. But then it's like the expectations are higher. And then it's like, why is RPO getting smaller? It's like, well, now I'm being punished almost for how well I did.
Right. And if you go back and you can look, because we've been public since 2021, you'll see RPO was very strong. Then it sort of started waning, and now it's back up. And it's all just as these large multi-year deals, become revenue until the next deal is done, the RPO, gets drained.
And what's your stance on multi-year deals? Do you incentivize the sales team to push for those? Do you think overall it's good for the business, net?
On a subscription model, yes, for sure. We want those customers locked in on a consumption model, less important to us. So, but on the traditional, which is still our predominant part of our business, our subscription deal, yes, we like them. We incentivize them a little bit, not a ton, but we want them to be multi-year, but we want them to have growth during that multi-year period, right? Mm-hmm. So built-in growth. So we never really like doing deals where it's, hey, we'll do 3 years, $1 million a year for 3 years, because you get a new business lift when you sign the deal, and then that customer could be flat for 3 years. We don't like that. We like to have ever-increasing growth built into those multi-year contracts on the subscription side. Again, on the consumption side, I'm less concerned. If a customer wants to do it, happy to do it, but it's not necessary in a consumption model.
I have realized this, I wouldn't call it an odd trend, but it's just happening now that even on the 1-year deals that I'll do, that auto renew, like I just got our Salesforce bill at my company, and they're like, we're gonna raise prices, because of cost of whatever you want to call it by like 9%. It's like, well, even though it's not a multi-year deal, you're still kind of raising the price on me, and it does have a built-in increase, especially if it's a sticky product that I'm not just going to pull out overnight.
Well, so we just did our Salesforce and we got the same thing. And so that's where, as a buyer, I've gone away from doing deals more than 2 years, right? Because we saw that, situations can change. And what I've seen is, a certain leader will say, well, I want this tool. This is the right thing for me. I'll do a 3-year deal. If that leader changes, the new one comes in and says, this isn't the solution. I want a different one, but then you're locked in. So we typically don't do more than 2 years, but yes, in that example, we don't want to expose ourselves every year to an increase. So I understand that. Look, every customer is different. We're different how we buy. My view to the field team has always been, let's do the deal the customer wants. Like, let's not force them to do multi-year or force them to do a big deal. let's do the deal the customer wants. And if we do that right and partner with them, they'll be back and we'll get more.
There you have it, the art and science of multi-year deals. And Greg, one of the reasons why I was so pumped to talk to you is you are very artful in the way that you interact with sell-side analysts on the calls. I've listened to a couple of them so far. I wanted to break down the relationships there. And what many people don't realize is that sell-side analyst relationship doesn't just stop after the questions from that earnings call. So do you do callbacks after you're all on that call?
Yeah, absolutely. Like literally, I'd say within 30 minutes after the sort of public earnings call, we started our callbacks. When we went public, we had 8 banks that took us public and covering us, and now we're up to 12 or 13. So yes, we go through everybody right after that. We used to do it where it was both me and our CEO, Matt, would do all 8 together because we could have time to do that. With 12 or 13, we do a handful together, and then we separate and do the rest independently. But yes, we cover everybody from the sell side right after the call. Occasionally, someone can't make it, and we'll reschedule them for the next day, but we get through everybody.
Maybe a super tactical question, but so multiple sell side analysts will call in to do like this, not a recap call, but the call after the call. Is it like a group setting where they're still asking questions?
Yeah, no, we do it bank by bank, one-on-one. They will sometimes bring multiple people. So if we're doing, with Morgan Stanley, there might be a couple people, but we're only talking to Morgan Stanley at that point. We're not doing it with, multiple banks at the same time.
I got to ask, so what's the level of prying to try to get info on the call that we all hear versus the callbacks? Does it ratchet up?
No, I think it's not a lot of prying. It's more of the sell side folks are trying to get more just clarification as they write their notes and have better understanding, given that they're going to have to articulate it to their client and customer base, right? So they want just to make sure that they have full clarity of what happened that you can't always get on the big call. And of course, when they want to ask questions on the earnings call, they might get 1 or 2 questions at most. And the other thing is, I think there's just you're not going to ask a real punchy question on that sort of more public call. And so if there's something that they really want to dig into, they'll do it more on the, the callback side.
And I have to imagine there is a level of just mutual respect where they're not going to try to, totally paint you against the wall with something bad, because then you're not going to help them update their models over time.
Well, I wouldn't say I would go tit for tat for them if they did that. But yes, there is generally a standard on the earnings call. And then if you really want to get into something deeper, you might do it on a callback. And then during the open window, which is the next 4 or 5 weeks, we could talk to them. We'll do non-deal road shows with, I try to do at least 1 to 2 of those a quarter, get much closer to those folks on the sell side and spend whatever time, for a couple of days really going into some of the details of, some just clarity that they can't always get from those sort of short callbacks.
And for the benefit of listeners who maybe haven't worked at a public company before, can you describe how that window works, what it is?
Yeah. So as soon as you do your earnings, more or less, the window is open because now we've done the earnings, we've shared all the financials, right? And, from a Reg FD perspective, it's all out there. And then that window stays open for us till about 2 weeks before the end of our current quarter, because we don't want to get too close to the end of the quarter and be answering questions that could be, giving information that would not, be within Reg FD. And, just generally you stay away from the end of the quarter. But for that 4 or 5 week period, then I can go to some of the banking conferences, speak to obviously the buy side freely, do these non-deal roadshows where we'll go out for a couple of days with one of the banks and their analyst, and we'll meet, 5 investors a day for a couple of days and go to a couple of different cities and just making sure. So for me, that's my way of selling the company, right? So I view myself as partly in sales, in that I go out and try to sell the company to either existing investors, new investors, and that's the window we can do it in. So for example, today, because our quarter ends a week from today, we're in our closed window. So we don't have any communication with, either really sell side or buy side.
Got it. That's super helpful perspective. Thanks for walking through that timeline. Greg, do you have any tips for maybe a younger CFO who may get tripped up and give analysts too much info? How do you avoid oversharing? Do you just have the metrics that you can and can't share on a piece of paper in front of you, or have you just done it for so long that I should back off from that?
Well, the first thing obviously is Reg FD, right? You got to stay compliant, right? So if there's information that you haven't shared publicly, you can't share that with small groups of investors. So look, we try to cover things on the call so that it's all out there. We try to make sure it's in either the investor deck or the press release or whatever, so that we can talk more freely about that. But look, yes, I have a little sheet that tells me of all the metrics I track, which ones are publicly disclosed, which ones are not publicly disclosed. So I try to make sure that I'm only talking about the things that, we've already shared. That said, you do have to, be thoughtful about the information you give in terms of helping people understand the business, helping understand what, the future looks like. So it is a learned thing. But I think for any young CFO, particularly if you're not in a public company, if you're private, get practice, get experience, go out there, go to these conferences, meet with investors, spend time with the sell side analysts. You'll get a feel of the questions. You'll start getting a feel of where they're trying to do sort of a bit of an end around to try to get something that might not be out there. And quite honestly, you just have to know, just be like, I'm sorry, I can't share that. Like, just say no if it's not something that's already been shared publicly.
You get good at saying no.
You have to, because again, everyone's trying to get that next level of information that if it's not disclosed, you just can't share.
Is triggering Reg D like a somewhat normal thing, or is it like a scarlet letter? What's the thinking there?
Well, I think everyone's goal is to not trigger it.
Yeah.
I think there's occasionally times, I fortunately I haven't had this yet, but there's times where people, certain things happen or are said that, that just ultimately need to get reported. Look, I learned long ago that I never have an investor meeting without having another person with me. Usually it's somebody from IR to make sure that, they can corroborate my story, that they're here for the meetings. And if anything does get said, that they can help correct or fix, whatever was said there. So that's the other thing I would never do as a public company. I would never do any kind of investor meeting, buy side, sell side, without having somebody else there from your team.
Always have backup.
Always.
Greg, you had said when you went public, I think you had 8 banks covering you, and now you're over 12. Can you maybe speak to the benefits of having analyst coverage? I mean, does it help with discoverability in the public markets? What does having analyst coverage do?
Yeah, I think it just gets a sort of a wider distribution of wider reach to an investor base, because there's some of the larger bulge banks, and then there's some mid-market banks. And look, we're small cap, and so we have a certain targeted investor base. And I think there's certain banks that can do that better than others, but we have to have all of the above. And look, we want to share the message about the company and what we're doing today and what our outlook is with as many people. So we do think it's important, sort of build up that base of coverage banks, and it just gets a wider, sort of marketing of Couchbase. So we've been proactively working on that to try to do that, and feel like we've done a pretty good job with that.
I'd be remiss if I didn't touch on the buy side of the equation. How do relationships there as a publicly traded company work? Because you could fill your whole day with investor meetings if you wanted to.
Yeah. So to that point, like during the open window, it's pretty busy, right? There's a lot of investor activity. And so there's usually sort of a flurry at the beginning, the callbacks to understand what happened on the call. And then there's a lot right before the window closes, because they just want to sort of get an update. How are things? How do you see the, in this case, like the macro environment? How do you see other things playing out, just to get a sense? And they're not just doing it with Couchbase, they're doing it with all the folks they deal with, because they're trying to get a thesis or a theme around how things are going to be playing out as they go into these earnings cycles. But look, I view them as our customers, right? They're those are the investors. Sell side's very important. They're not the investors. They're promoting it to their clients. But when I talk to buy side, these are people that are either owning the stock or are looking to own the stock. And so that's where I talk about getting into sales mode, and I view them as our customers, and I treat them with the utmost respect. And if anything, they're the ones who ask, quite honestly, the tougher questions than the sell side folks, because they're really in it. They've put their money behind Couchbase, and they want to make sure that their thesis on what's going to happen is really playing out. So, but I try to spend as much time as I can with the investor base, new, existing, anyone who really wants to chat and understand more about Couchbase.
And how do you divide your time between new and existing? Because you probably want to talk to, I'm making it up, like your top 5 investors pretty frequently, but then you're also always building a book of others who can buy the shares over time.
Yep. So there's absolutely, I'd say 5 to 10 buy-side investors who we talk to routinely every single quarter. They're larger investors. They've been long-term investors. They know the story well. And they're just trying to get, again, fine-tune on where things are at. At the same time, I go into every year with a list of targeted investors, 20 to 30 new investors that we specifically, try to go after, whether it's, individual meetings or more so when I talk about those non-deal roadshows. That's really why we try to go to some of these, various cities to try to get in front of folks that, quite honestly, if you don't get in front of them, especially being a small cap company, they got so much stuff going on. They're just not going to spend the time. So that's why we go in and we spend an hour with them and really help them understand the story and try to develop the relationship. And, it's been great. We've picked up a number of new investors through that, and some of them have become material, investors in the company.
The world does seem to be moving like terminally online, but I think like having those in-person relationships with them, to your point, like that's how you build relationships where you know where they're going to be with holding your stock or not over time. I
couldn't agree more. And I'm more than happy to, make the 2 or 3 day trip to get out there and spend time with folks rather than do, things on, video here. So I love the interaction. It's energizing. It's a lot of work, like 5 to 6 meetings in a day, telling the same story over and over is not easy, but absolutely worthwhile.
As much as I like to think that hedge funds are just taking the transcript and running it through sentiment analysis, it does matter.
It absolutely matters, especially with the hedge fund guys.
Greg, you had quite the career at GE before moving to kind of the startup ecosystem, startup at scale. What was working at GE like during its heyday? I mean, there are books written on that company and all the things they created and the culture there. What was it like?
I loved my time at GE. I spent 14 years there. My first day at GE was the day that Jack Welch handed over the CEO role to Jeff Immelt. So while I never really worked under the sort of Jack Welch regime, I could still feel it as I started. And then obviously Jeff took over from there. I thought it was fantastic. For me, it was a perfect time in my career. I wanted to be at a large global company where I could get great leadership, mentoring, training, opportunities, and I got all that. I worked with some of the most talented people in the world. If I look at where people have gone on to since leaving GE, it's just incredible, mass success. I got incredible training. I had opportunities to travel around the world. I moved around multiple times. I had an opportunity to take an assignment outside the United States. So it was a fantastic time.
You mentioned some pretty cool things that you got to do there. What took you out of your comfort zone?
Well, a couple things. One is I did get an opportunity to be an expat and lived in Paris for 2.5 years, right? So I moved the family when they were quite young, and running a global business from outside the United States, not being at sort of the headquarters, sort of understanding how that works. It's given me great perspective today that I'm at the headquarters for Couchbase, but I have a lot of understanding of how people around the world who aren't at the headquarters and don't feel like they, get all the information or at the center of at all how that works, because I wasn't. Time zones, that was fantastic. And then just living in a country and a culture that was so different than what I had been used to my entire life. It just gave me a wonderful perspective. And then secondly, they had some amazing training programs. There was one called Experience Financial Leadership Program, which I did, which was over 2 years. You did 6 1-week classes. 5 were internal, and you were with a group this whole time. 1 was external, so I got a week at Harvard, and then you did 2 month-long projects outside of your business. So I was in GE Healthcare, so I would leave GE Healthcare. One of them was in the U.S., which was where I was based, and one of them was outside the U.S., so I got to go to our oil and gas business in Florence, Italy, for a month, and then again got experience of working in a completely different business, completely different culture. And so it was the whole process of trying to build these sort of more well-rounded leaders, and that's what I think GE was well known for.
If you think about leadership from a corporate perspective, GE's name is probably in the dictionary. And I know you said that Jack Welch was handing over the reins at that point, but do you remember any of the famous frameworks that were preached?
Oh, yeah, absolutely. I mean, the one that still sticks with me to this day is just the concept around meritocracy, right? Which was merit based, which is, and I still would tell people this today. I'm sure folks that know me who are listening to this said that they've heard it before, which is, look, if you just put your head down and do some really good work, right, and show, care and passion about what you're doing, I believe you will achieve whatever it is you want to achieve. Now, for people, it's various things. It's opportunities to take on new roles and responsibilities. For some people, it's compensation. For some people, it's a title. For some people, it's, flexibility. I don't know what it is, but that's the big one that I took away from GE at the time, was around just the concept around meritocracy.
There's probably also something to be said about just seeing how a company operates at true scale. I'm talking like some of the biggest out there. I mean, did you have takeaways from that, good or bad?
Oh yeah, when people ask me about my GE, they're like, what do you take away? I'm like, rigor, process, operational excellence. Like, it was all a very well-oiled machine. And I got to learn from some great people about how to do, core operational and finance things. Now, at the same time, looking back on that, the flip of that, which again, I wouldn't trade for anything, the flip is you didn't have the ability to make, at least at my level, I didn't have the ability to make, big changes or big ideas, right? Because it was so well built that you just didn't have that sort of opportunity or flexibility. So I always liken it to, today I like to think of, I'm sort of in the cockpit of the airplane, like flying the airplane in this role. I was not even on the plane at the time. I was more like air traffic controlling and just making sure things didn't crash into each other. And so that's ultimately part of the reason I decided to leave, was because I wanted to get on the plane and ultimately into the cockpit. But yeah, I mean, it was just such a big machine. But again, I learned these core skills that I've now taken and applied to everywhere else I've gone.
Well, you certainly are in the cockpit today. And I was hoping you could talk about the way that you run Couchbase. You'd give me a couple bullet points.
Look, it's a framework that I started just a couple months before Matt Cain, our CEO, started, and he brought the framework, but I'm a believer in it, which is sustained differentiation, profitable growth, and world-class teams. And those are our three pillars. And Matt brought those in day one, and still today, almost every all hands we have, like, that goes up, right? That's the framework. And what it means is we have to build great product that people love. We have to sell it really well, but be mindful of becoming profitable. And at the same time, have this world-class, group of people supporting the people who are making the product and selling the product. And that's how I've always viewed my role in finance. Is we're and the rest of the world-class team is, we're enabling function, right? We're enabling the product teams to make great product, and we're enabling the selling teams to sell the great product that's out there. And so that's our role. And that's, if we're doing that every day and focused on that, that's how we're going to be successful.
Damn, you were preaching profitable growth at the very start. That must pull on your CFO heartstrings.
Well, it does. And just to be clear, because you all can see this, is we're not profitable today, but we have the mindset of running the business to be profitable. But you have to have that mindset from the very beginning, and I think we have.
That's awesome. I did want to ask one more thing about GE. And I asked you about getting out of your comfort zone. Something that must have brought a lot of people out of their comfort zone was that consent decree. I think you were there at the time. And didn't that shut down the business for like a year and a half?
Yeah, it did, CJ. That's a great one. That is a life experience. Trust me. Yeah, so I'd been at GE for about 5 years. I was asked to take a role, my first real sort of divisional CFO role in Salt Lake City. And my wife and I had always been open to moving. We just never had envisioned living in Salt Lake City, but it was wonderful. It was a great couple of years. But so I got to the business, I was doing the interview, and they mentioned that they had, the FDA, we were in a regulated industry, healthcare equipment, that the FDA had come in and had some findings, but they were working on them, and it'll get all sorted out. And of course, I was early in my career, I was a finance person. I wasn't thinking about, quality issues. At big GE, they'll figure it out. Well, I started there, and about 6 months after I started, the FDA came back in to re-audit, to check on the things. And unfortunately, not all those things were corrected, and they found some more, and they were severe enough where they put the business under consent decree, which is a federal court order, and they basically shut down the business. So the only thing we could do is service the equipment. We could no longer manufacture. So all the manufacturing was shut down. And this was a company that GE had acquired back in the late 90s, and it was a surgical piece of equipment, X-ray equipment, and it was mostly U.S. based, but they had something like 70 to 80% market share in the U.S. They were like the very dominant player, and all of a sudden we're shut down. And so everybody outside of service got reallocated. The manufacturing people were helping me do collections. We had people working on quality. Everybody in the business got reallocated. And fortunately, we didn't get, you don't get out of the consent decree, but you get authorized to start manufacturing again. And so we did that in 14 months, which at least is at the time and still maybe today one of the quickest to ever do that. But then it takes years and years after to ultimately get out of the consent decree, which they did. But yeah, we were shut down for 14 months. I was working on FASBs of how to account for shut down businesses. Had we not been part of the bigger GE, I'm not sure that business would have survived. So it was a very interesting time. It's the $1 million experience. You might never sign up for it, but it was an amazing opportunity to go through it, and it helped me appreciate how I think about quality and compliance today, which I put at the top of the pyramid, which is everything quality and compliance you have to do, no exceptions. Then you have the need to haves, and then you have the nice to haves. And so that's the framework I think of. So whenever there's a question about something, if it's quality or in my case now compliance related, you have to do it. You just simply don't have a choice.
And that's exactly what I was going to hit on. Like, listen, you never want that to happen to your company, but it did probably build this muscle for rigor around risk management and downside scenario analysis.
Most definitely. And again, it helped me with the framework of how I think about things when they do fall into that bucket of compliance, that there's just literally no exceptions. You have to fund it. You have to do it. If you don't, the outcome could be somewhat similar to what I experienced, which was not something you'd ever want to go through again.
Thanks for sharing that story. Greg, I'm going to take you into what we call our long ass lightning round. So the first question I ask everybody is, look, you're a successful guy, but you got to give me something that you've screwed up in your career. It could be on this job or a different one.
I remember I was early in my GE career, and I'm even today I'm a pretty prideful person, and I made a wrong journal entry for over $1 million. That was only found after the end of the quarter, but it was wrong, and it was when they reversed it, it cost the company $1 million of operating profit, and so that was a little embarrassing. I was sort of worried at that point that was going to be a very career limiting move. Fortunately, I had a great manager at the time who was just to help me go through that and understand. Just don't do it again, but you can survive it.
You were the $1 million man, no pun intended.
Yes, in the wrong way.
I can maybe match that. I one time transferred $10 million to the wrong account. We got it back, but I was the $10 million man that day.
Oh, yeah. See, at least there was no cash involved. This was just a journal entry. So, no money was on the line.
Easier to reverse. Next one I got for you. If you could tell your younger self something knowing what you know today, what would you tell him?
Don't worry so much. Careers are long, but when you're 30 years old, you think it's, I got to get to the next level. I got to get this title. I got to get this stuff. And little do you know, you've got 25 to 30 years left in your career to continue to sort of build on it. So don't worry. I'm a big fan of you got to build your toolkit throughout your career so that when you do have the opportunity to get into a CFO role or leadership role, that you've experienced or done what you're going to have to lead now, because you really can't go backwards. So take the time, build your career thoughtfully, but don't worry. Oh my gosh, I'm 30, I'm 40, I haven't achieved what I want. There's plenty of time left to be wildly successful.
That's great advice, because I keep myself up at night at times thinking like I thought I'd be here at this point or there, but like if it's a 35, 40-year career, you got to look at that in the long term. Right. And don't look around you and be like, oh, this person's ahead of me, or do your thing. If you're thoughtful and you do it the right way, you will ultimately be successful and get whatever you want to get. Looking back, is there one skill you wish you did have sooner or invested in more?
Well, at the time when I was at GE, because it was a big manufacturing environment, I really didn't go through a true like manufacturing, like cost accountant role. So that was one that I had to really, work towards to make sure I could be educated and thoughtful about that. But, that was the one. And that's where, again, it wasn't considered a very sexy role. And so that's probably why I avoided it. And there was a sort of a different path where I felt like, I could get, faster to where I wanted to go. But I missed having that skill. And given that I spent 14 years and the majority of the 14 years was in the manufacturing world, I regretted not sort of spending time there.
Can you walk me through your finance software stack? What tools do you use today to get the job done?
Oh, yeah, we have a number. I mean, we use NetSuite for our ERP, RevPro for revenue recognition. We have Navan for travel expense and such. We have Blackline for account reconciliations. I mean, there's a number of tools, and obviously it's not ours, but Salesforce is obviously a huge part from a CRM perspective in terms of how we run the business. So those are some of the main ones that we use. But there's obviously many, and as you experience too, right? They're growing every day, and there's new stuff coming out, and so trying to stay on top of it is really important.
Got it. What's the most recent tool you've bought?
We invested in a tool called Pigment almost a year ago now, 9 months, a year ago. It's an FP&A software tool. So we had been working with a company called Vena since I almost got here. And after 5 years, we just need something that was a little bit more scaled, and so we went with Pigment. So we're implemented, and we're continuing to grow on that platform, and excited for what that brings for FP&A in terms of not only reporting, but particularly I'm keen on what analysis and insights we can glean from the business by using that.
Last one I got for you. You've been at this a while. What's the craziest thing you've ever had someone try to expense?
A cruise, and justifying it as a customer event. So that was, I've seen golf and I've seen concerts and sport things, but 3-day cruise was the first one that I had ever seen. So that one was a little off-piste, if you will.
Yeah. Off to Mexico or the Caribbean. That's an aggressive one.
Yeah, well, again, they had customers, so they said, hey, it's a customer event, which was factual. It's just something that was a little bit beyond what was probably in the policy at the time.
That's awesome. Greg, before we go, I do want to give a shout out to CFO Circle and Mike Jung for introducing us. They've been really kind to me, and I know you're a part of their group.
Great group, amazing people. I moved out to the Bay Area 9 years ago, and I was quickly introduced to them, and really helped me create a great network that I've leveraged many, many times throughout my time here in the Bay Area. And yes, the founders folks and the circle are amazing.
Shout out CFO Circle. Thank you. Greg, thank you so much for being generous with your time. I know you got a ton going on. This has been immensely helpful for me, a young CFO, and I know everyone else will appreciate your insights.
I appreciate it. Thanks for having me, CJ, and love what you do, and looking forward to listening to more of your podcasts.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.